It usually happens on a Friday evening, the worst possible time for a financial crisis. You are standing at the checkout counter of a grocery store with a cart full of food for the week, or perhaps you are at a nice restaurant with friends about to pay for a celebratory dinner. You feel confident. You know you have a $50,000 limit on your line of credit. You tap your card, a moment of silence, then a sharp dissonant beep. Declined. You frown thinking it is a chip error or a connection issue. You smile apologetically at the cashier or the waiter. You wipe the card on your shirt and insert it into the machine. You enter your PIN with deliberate care. Processing, declined. Contact issuer. You feel the heat rising in your cheeks. The people behind you in line are starting to shift impatiently. You pull out your phone to check your banking app, expecting to see a fraud alert or a glitch. But when you log in, you see something far more terrifying than a hacked account. You see your balance, and right next to it, you see your available credit. Yesterday, it said $50,000 available. Today, the number is 0. The bank has not just declined a transaction. They have unilaterally, instantly, and without warning, reduced your credit limit to match your current balance. The safety net you have relied on for 3 years is gone. The financial oxygen has been sucked out of the room. You are standing there with a worthless piece of plastic, realizing that your entire financial reality has just shifted beneath your feet. Welcome back to Canada Property Watch. We have taken you through the harrowing journey of the margin call letter. We have walked you through the devastation of eviction day and the power of sale process. But today, we are investigating the silent killer that usually precedes both of those events. We are talking about the HELOC freeze. We are talking about the sudden, quiet disappearance of billions of dollars in consumer liquidity that is happening right now, behind the scenes. While the media focuses on mortgage renewals and interest rates, a far more insidious crisis is unfolding in the banking servers of the Big Six. Banks are quietly auditing their loan books, reappraising properties using automated valuation models, and slashing home equity lines of credit for thousands of customers. This is the credit crunch. Then, this is the moment when the bank stops being your partner and starts being your liquidator. In this deep dive report, we are going to expose the legal clause that allows them to do this. We will explain why your approved limit is an illusion. We will look at the brutal math of loan-to-value ratios that is triggering these freezes. We will discuss the algorithms that monitor your spending habits to predict your collapse. And we will explain why, for the Canadian middle class, the ATM is officially out of order. To understand why this is happening, you have to understand what a home equity line of credit, or HELOC, actually is. For the last decade, Canadians have treated their HELOCs like a second bank account. We viewed it as our money. We used them to renovate kitchens. We used them to buy cars. And we use them to fund down payments on investment condos. We use them to pay for vacations and weddings. We operated under the assumption that as long as we paid the interest, the money was ours to use forever. We were wrong. A HELOC is not a savings account. It is not even a standard loan. In banking terms, it is a demand loan. This is a crucial legal distinction that 99% of borrowers do not understand. When you sign a mortgage for a 5-year term, you have a contract. As long as you make your payments, the bank cannot ask for the money back before the 5 years are up. You have security of tenure, but a HELOC is different. It is a callable debt. It is a revolving credit facility that exists at the pleasure of the lender. If you read the fine print of your home equity line of credit agreement, and usually buried in a paragraph on page 4 or 5, you will find a clause that says something to this effect. The bank reserves the right to demand repayment of the outstanding balance in full at any time, for any reason, or to reduce the credit limit without prior notice. At any time, for any reason, without prior notice. Think about those words. They mean that your financial stability is entirely dependent on the bank's mood, or more accurately, the bank's risk appetite. During the boom times, the banks never exercised this right. Why would they? Property values were going up every month. Your house was a gold mine. Lending you money at prime plus 1% was easy profit for them. They wanted you to borrow. They sent you letters increasing your limit. They encouraged you to use the equity. They wanted you to be in debt. But now, Benos, the tide has turned. The asset securing that loan, your house, is dropping in value, and banks are allergic to risk. Let us look at the brutal math that is triggering these freezes. It all comes down to the loan-to-value ratio, or LTV. By law, and by internal risk policies set by the Office of the Superintendent of Financial Institutions, banks can only lend you a certain percentage of your home's value. Typically, you can borrow up to 80% of the value of your home, combining your mortgage and your HELOC. This is the hard cap. Let's take a theoretical borrower named David. In 2022, the peak of the market, David's house was appraised at $1 million. He had a mortgage of $500,000. The bank said, "Great, you have lots of equity. We will give you a HELOC with a limit of $300,000. So, total debt potential is $800,000, which is exactly 80% of $1 million. David feels rich. He has access to $300,000 of liquidity. He spends $50,000 on a renovation and uses another $50,000 to supplement his income when rates went up. He has a balance of $100,000 and an available limit of $200,000. He sleeps well at night knowing that $200,000 is there if he loses his job. Fast forward to 2026. The real estate market in David's neighborhood has corrected. Prices are down 20%. This is not a crash, it is a correction. David's house is no longer worth $1 million. It is now worth $800,000. The bank's automated valuation model, or AVM, runs a nightly scan of the portfolio. The system flags this drop, and it sees that comparable homes on David Street are selling for $800,000. The algorithm runs the numbers. The house is worth $800,000. The maximum loan-to-value ratio allowed is 80%. That means the maximum total debt David can have on this house is $640,000. But wait, David still has a mortgage of nearly $500,000, and he has drawn $100,000 on his HELOC. His total utilized debt is $600,000. He is close to the limit, but he is still under it. However, his approved limit was set when the house was worth $1 million. If he were to draw the full remaining $200,000 on his HELOC, his total debt would be $800,000 on a house worth $800,000. That is 100% loan to value. And the bank cannot allow this. It is a regulatory violation. It exposes the bank to unsecured risk. If David defaults and they sell the house, selling costs and realtor fees would mean the bank loses money. It is an unacceptable risk for the shareholders. So, on a Tuesday morning, the bank's computer system executes a limit reduction. It does not call David to discuss it. It simply looks at his current balance of $100,000 and says, that is the new cap. It slashes his available credit from $200,000 down to zero. It freezes the account at the current balance. David doesn't know this happened until his card is declined. He calls the bank, furious. He says, "I have a credit score of 800. I have never missed a payment. I am a loyal customer for 20 years. Why did you do this?" The agent on the phone, and reading from a script, says, "Due to a change in the valuation of the security, we have adjusted your borrowing limit to align with current market conditions." This is the credit crunch. It is not happening because people are defaulting. It is happening because the collateral is shrinking. And the terrifying part is that this is happening systematically across the board to borrowers who think they are safe. It is a mass deleveraging event orchestrated by the risk management departments of the major banks. This HELOC freeze is the first domino in a chain reaction that leads to insolvency. For many high-income households, the HELOC was the life support system. As mortgage payments doubled due to interest rate hikes, families were using their line of credit to cover the shortfall. They were borrowing from the house to pay for the house. It is a negative feedback loop known as capitalizing the interest, but it kept them alive. It bought them time. It allowed them to maintain their lifestyle and keep the kids in private school. When the bank freezes the HELOC, they cut the oxygen line. Suddenly, the family has to pay the full mortgage, the full grocery bill, and the interest on the HELOC entirely from their cash flow. But their cash flow is negative. That is why they were borrowing in the first place. So, what do? They panic. They turn to the next available source of funds: unsecured credit cards. When the HELOC at 7% is frozen, they start putting groceries, gas, and utility bills on Visa and MasterCard at 21% or 29% interest. This accelerates the death spiral. You cannot sustain lifestyle expenses at 29% interest. Oh, it is mathematically impossible. Within 6 months, the credit cards are maxed out. Then they go to the private lenders, the second mortgages at 15% plus fees. And finally, they crash. The HELOC freeze is the early warning signal that the bank has lost confidence in you, or more specifically, lost confidence in your asset. It is a vote of non-confidence from the financial system. It is the bank saying, "We are getting out before you go down." There is another layer to this. It is not just about house prices. It is about the OSFI regulations and the Basel III banking accords. The Office of the Superintendent of Financial Institutions is the regulator that oversees Canada's banks. They enforce capital adequacy requirements. They tell the banks how much money they must hold in reserve to cover potential losses. When house prices fall, the risk weight of the mortgage portfolio increases. The banks are required to hold more capital against those loans. Holding capital is expensive for a bank. It reduces their profitability. So, to improve their capital ratios, the banks need to reduce their exposure to risky assets. The easiest way to do that is to cut undrawn lines of credit. An undrawn HELOC is a liability for a bank. It is money they have committed to lend you, but aren't earning interest on yet. In a crisis, if everyone draws on their HELOCs at once, it could cause a liquidity run on the bank. So, the banks are preemptively closing these doors. They are de-risking their portfolios. They are cleaning up their balance sheets to please the regulators and the shareholders. And the banks are also using advanced AI algorithms to monitor your behavior. They are not just looking at your house price, they are looking at your spending. They call this the behavioral score. If the algorithm sees that you are suddenly spending money at liquor stores, casinos, or divorce lawyers, it flags you as high risk. If it sees that you are making only the minimum payments on your credit cards, it flags you. If it sees a drop in your payroll deposits, implying a job loss, it flags you. The AI combines this behavioral data with the drop in your home's value and makes a decision to cut your limit. It happens automatically. No human reviews it until you call to complain, and by then, it is too late. The decision has been made. This shift in banking behavior marks the end of an era. For 15 years, money was free. Credit was abundant. Banks were aggressively selling debt. They would call you at dinner time to offer you a credit limit increase. Do you remember those calls? We don't get those calls anymore. Now, the letters we get are notices of changes to terms and conditions. The era of easy money is over. We are entering the era of credit contraction. The psychological impact of the HELOC freeze is devastating. For the house rich, cash poor generation, the HELOC was their wealth. They didn't have savings accounts, they had available credit. They looked at that $50,000 available on their banking app and felt secure. They thought, if I lose my job, I have a buffer. If the furnace breaks, I have a buffer. If the car breaks down, I can fix it. When that number turns to zero, the psychological safety net vanishes. The anxiety sets in. Every purchase becomes stressful. The illusion of wealth is shattered. They realize they are not wealthy, they are just indebted. They realize that their lifestyle was entirely dependent on the bank's permission. This is also destroying the small business community. This is a critical point that is often overlooked. Many entrepreneurs, contractors, and consultants in Canada fund their businesses using their personal HELOC. It is cheaper and easier than getting a business loan. They use their home equity to buy materials, to pay payroll during slow months, to expand their operations. When the bank freezes the personal HELOC, they are effectively freezing the business's operating capital. We are seeing contractors who cannot buy lumber for the next job because their card was declined. We are seeing consultants who cannot pay their staff because their line of credit was cut. The bank has inadvertently strangled the small business sector by tightening residential lending standards. This will lead to layoffs and a slowdown in the broader economy, which ironically will cause more loan defaults. It is a self-fulfilling prophecy. And let us talk about the callable nature of the loan again. What happens if the freeze isn't enough? What happens if the property value drops so much that you are underwater even with the limit cut? The bank can issue a demand for payment. They can say, we don't just want to freeze the limit. We want you to pay down the balance by $50,000 immediately to restore the margin. This is the margin call on the HELOC. It is rare, but it is happening. And it usually happens to real estate investors who own multiple properties. Imagine an investor with 5 condos, all cross-collateralized. The bank sees the portfolio value crashing. They freeze all 5 HELOCs. Then they demand a paydown of $200,000 to rebalance the portfolio. The investor doesn't have the cash. They are forced to sell properties into a falling market. This increases the supply of homes for sale, driving prices down further, which triggers more HELOC freezes for other people. This is the mechanism of a deleveraging cycle. It is the reverse of the boom. On the way up, rising prices created more credit, which fueled more buying, which raised prices. It was a virtuous cycle. On the way down, falling prices destroy credit, which forces selling, which lowers prices. It is a vicious cycle. We are currently in the acceleration phase of this downward spiral. This situation also creates a massive vulnerability for those with auto loans and leases. Many people use their HELOC to buy out their car lease at the end of the term. If the HELOC is frozen, they cannot buy out the car. They have to return it. Or if they were using the HELOC to make the monthly lease payments, they now default on the car. We are seeing a spike in vehicle repossessions directly correlated to HELOC freezes. It is all connected. The house is the foundation of the Canadian financial life, and when the foundation cracks, the whole structure shakes. So, how do you know if you are at risk? First, check your mail and your email. Banks are required to notify you, but they often bury these notices in standard statements or send them digitally. And do not ignore letters from the bank. Second, look at your loan-to-value ratio. Be honest with yourself about what your home is worth today, not what it was worth in 2022. Look at the comparable sales on your street. If your total debt is approaching 80% of today's value, you are in the danger zone. You are a prime candidate for a freeze. Third, watch your credit utilization. If you are maxing out your credit cards, your credit score drops. This is a red flag for the bank's algorithm. A dropping credit score can trigger a HELOC review even if your house price is stable. The bank thinks, this person is desperate, let's cut them off before they take more money. What should you do if your HELOC is frozen? Do not panic, but act immediately. Call the bank. Sometimes it is an automated error, or if you believe the bank's automated valuation is wrong, you can offer to pay for a professional appraisal. If a human appraiser visits your home and values it higher than the computer did, the bank may reinstate your limit. But be careful, a new appraisal might confirm the lower value and lock in the freeze permanently. It is a gamble. If the freeze is permanent, you need to restructure your finances immediately. You cannot live on debt anymore. You need to cut expenses to the bone. You need to enter survival mode. Cancel the subscriptions. Sell the second car. Stop the renovations. If you have other assets, liquid assets like stocks, bonds, or crypto, consider selling them to pay down the debt. It is better to sell a stock portfolio than to lose your house. You need to reduce your leverage. And most importantly, stop using the credit cards to fill the gap. That is the trap. Once you start carrying a balance at 21% interest, the math becomes impossible. You are sprinting toward bankruptcy. The interest will consume your income faster than you can earn it. If you are a saver, if you are sitting on cash, this environment is your opportunity. The credit crunch means cash is king. As borrowers are forced to sell assets to pay down debt, prices will fall. You will be able to buy assets, homes, cars, businesses at a discount. The wealth transfer is happening. It is moving from the borrowers to the savers, from the leverage to the liquid. The era of using your house as an ATM is over. The machine has been unplugged. The screen is dark. The message insufficient funds is flashing for an entire generation of Canadian homeowners. The banks are protecting themselves. They are building their fortress walls higher. They are leaving you outside the gate. The question is no longer, how much can I borrow? The question is, how much can I pay back before they call the loan? There is one final aspect of this that we must discuss, the joint and several liability. Many HELOCs are joint accounts between spouses or even parents and children. If the bank freezes the account, it affects everyone on that title. If you co-signed a HELOC for your child to buy a condo and that condo drops in value, the bank can freeze your HELOC on your primary residence to cover the risk. The contagion spreads within families. We are seeing parents' retirement plans destroyed because they co-signed for their children's debts during the bubble. The bank has the right to offset debts. And this is called the right of offset. If you have a HELOC that is in default or considered high risk and you have a savings account or a checking account at the same bank, the bank can legally take money from your checking account to pay down the HELOC without your permission. They can reach into your payroll deposit and take it. This is why, if you are in trouble, you should keep your savings at a different bank than your debts. Do not keep all your eggs in one basket. In our next report, we are going to look at the next stage of this crisis. We are going to examine what happens when the banks stop trusting each other and how the liquidity crisis in the shadow banking sector is spilling over into the major financial institutions. We will also discuss the tax implications of liquidating assets to pay down debt. And subscribe to Canada Property Watch. We are tracking the silent signals that the mainstream media ignores. We are watching the credit limits, the foreclosure notices, and the bankruptcy filings. We are here to help you navigate the great deleveraging. Check your banking app, check your limit, and don't rely on money that isn't yours.